Greetings, and welcome to the High Flying Tutors Academy channel. Today I'm going to be assisting you on this question. This is a practical accounting question, and then we are required to record this or every transaction into this format, right? So without any waste of time, I'll go and start. So they say the following transactions relating to the dream dress sewing took place during January 2024. And then transaction number 1, the owner contributed a sewing machine to the value of 15,000 and 20,000 cash to the business, right? So when you look at this transaction number 1, when the owner is contributing some resources into the business, those resources are capital, right? So it means number 1, because the owner is contributing some resources in the business, therefore capital is one of the account affected on this transaction. And then we're going to look at the resources that the owner has contributed. One of the resources that the owner has contributed is machine, and the other resource is cash, is money, right? So in this transaction, we've got 3 accounts affected. Number 1 is capital, number 2 is machinery, and number 3 is money, which is bank, because a cash in accounting we call it bank, right? So we've got 3 accounts affected, so we need to record this transaction number 1 into this kind of a format. So number 1, they say we must indicate the number right there, so it's transaction number 1. And then what is the source document? So transaction number 1, I'm going to divide it into 2 transactions where we're going to record the contribution of the machine by the owner, and we're also going to record the contribution of the cash by the owner, right? So now I'm gonna start with the one where the owner is contributing the machine, right? So when the owner is contributing the machine, 2 accounts affected is going to be capital and the machine itself, right? So I'm going to record this transaction first, the one that I highlighted right there. So the source document for that is going to be a general voucher. The source document for transaction number 1, where I'm just recording for the transaction where the owner is contributing the machine, is going to be general voucher. So general voucher is a source document that we record where there is no cash transaction involved. That source document is called a general voucher. It's a source document where we record transactions where cash is not involved, right? So the source document for this machine and capital is going to be general voucher, and then the subsidiary general is going to be general GJ, right? GJ, you can say GJ, or you can write in full general, right? And then 2 accounts affected is going to be capital and machine, right? So machine, it's an remember, when you in terms of debiting and crediting, you need to understand the principles of the elements of financial statements, which is asset, owner's equity, liabilities, income and expenses, right? In terms of debit, credit, where does asset increase, where does asset decrease, and all other elements of financial statements. So machinery is an asset, and since the machine was contributed into the business, that means there's an increase in machines. So the principle says whenever asset increases, we must debit, and whenever it decreases, we must credit. So the machine is an asset and is increasing. It means we must debit what? Machinery. And then we're going to credit what? Capital. Why? Capital is an owner's equity account, and it's increasing the ownership in the business or the value of the owner into the business. So capital is an owner's equity and is increasing, and the principle says whenever owner's equity increases, we must credit. So we're going to credit an account called capital, which falls under owner's equity capital. Right, that is how we record our transaction number one. And then there is another transaction where the owner has contributed cash into the business in transaction number one. Right, so the transaction of cash where the owner has contributed cash of 20,000. So we're going to record this transaction again in the second line. So the general, the source document for transaction of cash where the owner is contributing cash, the source document is going to be our bank statement. Bank statements, right? And then where are we going to record in terms of the book of time of entry or subsidiary journal? We are going to record this in the cash receipt journal, CRJ, because we are receiving money into the business from the owner. So there's the receiving of money right there, right? So CRJ is a journal or book of prime of entry where we record our transactions where we receive money in the business, right? And then our two accounts affected is going to be bank and our capital. Bank and capital. So you're just gonna come here and say a bank, and then because bank is an asset and it's increasing because there's money into the business and an increase in money into the business, and money in accounting is called bank, right? So there's an increase in our asset, is in our monies, and whenever money increases we debit the bank because bank is an asset, and whenever asset increases we debit. All right, and then we obviously want to credit capital because capital is an owner's equity account, and whenever owner's equity increases we credit, right? That is how you should record our transaction number one. Okay, so now let's proceed and go to transaction number two. Transaction number two, they say you rendered a sewing service for a wedding to a client on credit for 45,750. So what are the two accounts affected there? So two accounts affected there is going to be service rendered and debtors control, because you sold on credit. It's like you sold a service on credit when you render a service. So let's go and record according to the table provided below. Transaction number two, what is the source document since you rendered a service on credit? When you render a service on credit, the source document is going to be a duplicate invoice. It's going to be duplicate invoice. Duplicate invoice, okay? And then the book of prime of entry is going to be debtors journal, DJ, right? That is how we abbreviate it, debtors journal. And then two accounts affected on that transaction is going to be debtors, or you can say debtors control. And then the other account is because remember we debit debtors because debtors is an asset. A debtor is an asset, and when it increases we debit, and then we rendered a service. So the other account that is affected is going to be a service rendered. Service rendered is an income account, and incomes increase on the credit side. That is why we're going to credit our service rendered. Service rendered. Service rendered right there. Okay, that's how we record our transaction number two. And then let's go to transaction number three. Let's go and read up there. What does transaction number three say? Transaction number three, they say you have rendered a sewing service amounting to 32,460 cash, right? So now we have to record this transaction. So what is the source document when you rendered a service for cash, what is the source document? The source document is going to be a duplicate receipt. Duplicate receipt. And then the book of prime of entry or subsidiary journal is going to be a cash receipt journal, which is CRJ. All right, and then two accounts affected because you received the money, bank, because bank is an asset, and whenever asset increases, you debit, and then you are going to credit service rendered. Because service rendered it's an income account, and whenever income increases, we credit, right? So that is how you're supposed to record our transaction number 3. Okay, and then our transaction number 4. Let's go and check up there what does transaction number 4 requires us to do. So transaction number 4 says you bought a sewing machine for 40,000 on credit from AB store. So you bought a sewing machine. So when you buy a sewing machine on credit, two accounts affected right there is going to be creditors and the machinery, right? But let's go and record according to the table provided below. So when you buy on credit, the source document as original invoice. Original invoice. Original invoice. Original invoice. And then you're going to record you're going to record the book of prime of entry. The book of prime of entry is going to be creditors journal. Creditors journal is CJ, right? CJ. Okay. And then two accounts affected. We've got the machinery that was purchased or bought, and creditors. So number 1, we're going to record an increase in machine. Remember, machinery is an asset, and whenever we have got an increase in our assets, it means we must debit. So you're going to debit our machinery right there. And then in creditors, according to the principle of the elements of financial statements, that is a liability. Creditors are liabilities, and whenever liabilities are increasing, we must credit. So we're going to credit our creditors. We're going to credit our creditors, and then we go to the next transaction. That's how you're supposed to record transaction number 4. Transaction number 5. Transaction number 5, it says received an invoice for sewing materials for 40,000 on credit from ABC suppliers, right? So how do we record this transaction? You received an invoice. So when you receive an invoice, it just means you bought on credit. Even if this credit here was not indicated that you bought on credit from AB suppliers, they just said you received an invoice. When you receive an invoice, it indicates that you've purchased on credit, right? So a source document on this transaction is going to be original invoice. It's the same as transaction number 4, where you purchased on credit. So it's going to be original invoice. Original invoice. Original invoice. And then remember, we're going to record in the CJ, which is creditors journal. Creditors journal. And then we purchase the materials, right? So materials are going to be regarded as an expense. So we're going to credit our expense because the principle says whenever there's an increase in expenses, we must debit them. I mean to say, we're going to debit our expenses. So we're going to debit our materials. We're going to debit our materials and credit our creditors because we've purchased on credit. So we're going to have creditors because remember, creditors are liabilities. And whenever there's an increase in our liabilities, we must credit them, right? Whenever there's an increase in our creditors, we must credit them. And then materials, we regard them as our expenses. And then whenever there's an increase in our expenses, the principle of the element says we must debit expenses, right? And then transaction number 6. Let's go to transaction number 6, and that is how you record transaction number 5. So transaction number 6 says received a credit note for poor quality of material. So you received a credit note. So when you receive a credit note, it means there was a poor quality of material that you did not like, or maybe there was a certain material that was not in good condition. Or so now we have to return it. So when we return, we receive a credit note, right? So the source document here is going to be credit note received. You can say credit note received. Going to be credit note received. So the source document right there is going to be a credit note received. Credit note received. And then where we record when we receive a credit note, it means we have returned that poor quality material, and then we are going to receive a credit note from our creditors, and then the book of prime of entry or the subsidiary journal is going to be creditors allowances journal, CAJ, creditors allowances journal, right? And then 2 accounts affected again is going to be credited. There will be a decrease in our creditors and there will be a decrease in our materials because we have took some material back to the supplier. And then if you were owing a supplier 5 rand, for example, and then because you bought maybe goods for 5 rand, if you return goods that are equal to or that are worth 2 rand, you're gonna be owing the supplier 3 rand at the moment. So it means there's a decrease in your value that you're supposed to pay to them or into your creditors, into the amount that you're supposed to pay to your creditors. So even here, there's a decrease in your creditors. So you're going to credit our creditors. I mean, you're going to debit them because when they decrease, you must credit them. When they increase, you must credit them, I mean to say. And then when they decrease, you must debit them, right? So you are going to debit your creditors because they are decreasing. As I was giving an example, creditors. And then you're gonna credit your materials. There's a decrease in your expenses here of materials, right? There's a decrease in expenditure of your materials. So there's a decrease in your expenditure now or expenses. So when there's a decrease in expenses, you must credit. So you're going to say materials on the credit side. Right, materials, okay. And then that is how it's just the vice versa of transaction number 5. That's what exactly happened. There was a return of materials that was made to the creditors or to the suppliers, right? And then let's go to transaction number 7. That is how you're supposed to record transaction number 6, okay? So let's go to transaction number 7. Transaction number 7. Transaction number 7. I'm just gonna go there. Just want to fix this. Just to create space here. Okay. And then transaction number 7. Let's just go and record transaction number 7. So transaction number 7, they say you paid 2,000 to ABC supplier. So you paid your suppliers 2,000 rand. Okay. So you paid your suppliers 2,000 rand. So when you are paying your suppliers, when you pay your suppliers, they are going to give you an original receipt. You're going to get original receipt. pay cash to your suppliers, you're going to get a source document called original receipt. And then because you are making a payment, and then you're going to record that in the book of prime of entry called cash payment journal, CPJ. Okay, and then two accounts affected here is going to be creditors. They are decreasing because you are making a payment to them, right? So it's going to be creditors, and you are also going to credit your bank because your bank is decreasing and your bank is an asset, and whenever asset decreases, you credit. Creditors are debited because they are decreasing and they are liabilities, and whenever liabilities are decreasing, you have to debit them, right? So that is how you were supposed to record our transaction number 7, right? And then let's go to transaction number 8. Transaction number 8, they say you wages paid for the month amount to 3,500. So you've paid wages, like it's like wages paid. You've paid wages to your employees, right? So the source document, they can be a pay slip, okay? Pay slip. Source document can be pay slip right there. The source document can be a bank statement as well. So we're just gonna say a pay slip, okay? And then because you made a payment, is going to be a cash payment journal. That is your book of prime of entry, cash payment journal, right? And then two accounts affected is going to be wages and bank because you made a payment, right? So there's a decrease in the bank because you're making a payment, money out, right? And then you're gonna debit wages because wages are expenses, and whenever there's an increase in your expenses or whenever expenses incur in the business, we must debit them. And then we're going to credit bank because we made a payment. You're going to credit bank because you made a payment, and whenever you make a payment, there's a decrease in cash in your business, and cash is bank, and whenever your bank is decreasing, it's an asset, and whenever asset decreases, you must credit it, right? So that is why we are crediting our bank and debiting our wages, which is an expense. That is how you're supposed to record transaction number 8. So let's go to transaction number 9. Transaction number 9, they say you've made an EFT payment for a telephone account, 1,500. So whenever you make an EFT payment, the source document is the EFT. The source document is going to be EFT, okay? And then because you made a payment, the book of prime of entry or subsidiary journal is going to be cash payment journal, right? And then account to be debited is going to be the expenditure. Like we did with wages, we're going to debit our telephone because telephone is an expense. And expenses, when they incur in the business, we must debit them in a transaction. And then we credit your bank, which is the payment you've made, bank, right? So that is how you're supposed to record all of this transaction from transaction number 1 to transaction number 9 in this table. That is how you're supposed to record this transactions that are given up there. So I hope you guys understand this. Please subscribe to my YouTube channel. Do not forget to like, comment,